Microsoft made a huge announcement stating that they are permanently closing all of their retail stores moving forward, and they're going to only operate and sell products direct to consumer through their digital presence. So Microsoft announced that all of their retail stores across the globe are going to be permanently closed, and they're going to shift those employees and those customers directly online. So we're going to go over a couple key points from this article. We're going to talk about what's going to happen to Microsoft now that it has permanently closed all of its retail stores, and we're going to do a deep analysis on Microsoft stock. We're going to go over their past performance. We're going to take a look at their future estimates as well, go through their financial statements to determine if whether or not it's time to buy Microsoft right now. But before we do that, I am going to ask, can you please like and subscribe? I am the Gen Z investor, and every single day we come out with videos that talk about different stocks you can buy into your portfolio, and we talk about the overall performance of the stock market or any stock market related news. And of course, we do that every single day. So I am going to ask if you please hit that like button. It really does help my channel grow, and I do appreciate everyone who takes the quick second to do that. So we're going to jump right into the video. We're not going to hold off any longer. We're going to go over some key points from these articles that I have here about the store closures. Then we'll move over directly into the Microsoft stock analysis. So a couple of key points here from this article from The Verge just states about how Microsoft plans to permanently close all their store locations in the US and around the world. A couple of their locations, there's 4 that are going to stay open that just are going to be used as experience centers, probably just to show off new and innovative products and designs. Microsoft already has a huge digital presence where they reach up to 1.2 billion monthly customers in over 190 markets each month. So they reach over 1.2 billion monthly customers in 190 different countries on their online stores already. So this shift isn't going to be a huge dramatic change for the company. This article right here comes from Microsoft.com itself, so directly from the source. And this really talks about what's going to happen to the financials with regard to this store closure. So you can see here the company's closing of Microsoft physical store locations will result in a pre-tax charge of approximately $450 million or 5 cents per share to be recorded in the current quarter ending June 30th, 2020. So of course, $450 million does seem like a large amount, but Microsoft, who generates over close to $140 billion in revenue, and over the past 12 months has net income over $40 billion, that this $452 million little pre-tax charge is not going to be anything too crazy and is not going to dramatically impact the company. So now we're going to jump into Microsoft stock analysis. We're going to go over company fundamentals, go over how it's performed, and how we're expecting it to perform moving forward. So we take a look here. Current trading for Microsoft is just around $196 a share. It actually did reach an all-time high last week and crossed the $200 a share mark if you look here on the 52-week range. Over the past 6 months, the stock is up 23%, and you can see this was pre-pandemic highs. It did see that nice dip, but has once recovered and actually surpassed its pre-pandemic highs and reached an all-time high. If we take a look at the 5-year chart, you can see their share price has been astounding, growing at over 333% over the past 5 years. One share of Microsoft 5 years ago was trading around $45 a share, and now you can see the current price is around $196 a share. So absolute insane growth over the past 5 years. And if you were unaware, Microsoft is actually the largest company in the US and on the S&P 500. They have a $1.5 trillion market cap, and that is trillion with a T. They are number 1. Second, just closely behind them is, of course, Apple, and then followed by Amazon. So if you were to purchase a simple S&P 500 index fund, close to 6% of every dollar, of every $100 you have or every dollar you have into that fund is actually going to be invested into Microsoft stock. So that's how much of a percentage they actually have. They actually own a huge, close to 6% of the overall S&P 500. Next, we're going to jump over to Simply Wall Street. We'll just go over some couple key points about Microsoft before we look at their company stock fundamentals, and we're going to just go through overall price performance over the past 5 years. So you can see here just a quick summary. If you do not really know what Microsoft does, they develop, license, and support software services, devices, and solutions worldwide. Of course, they are a tech company, and I'm sure you've used many of their different products throughout your life. So you see here some key points right here. Microsoft's P ratio of 32.4 is below software industry average. Earnings forecast to grow close to 11% per year. Earnings grew by a massive 32% over the past year and pays a very safe and very reliable 1% dividend that is actually growing extremely fast year over year. We'll take a look at that in a little bit. Next, we're going to take a look at how the stock has performed. This last 1 year has been very crazy. We saw a over 30% drop in overall market shares. And of course, we did see an economic shutdown where the entire US economy was almost completely shut down for about 2 to 3 months. So we're going to take a look at how Microsoft weathered that storm and how they performed during that same time. So on the 1 year return, you can see Microsoft is up 46.6%. The entire US software system and sector that has actually very much benefited during this economic shutdown is up close to 35%. So they still have outperformed their sector. And the overall US market is only up 3.4%. So the overall market has recovered from those pre-pandemic levels, but they are only up 3.4% compared to individual Microsoft, who's up 46.6%. Of course, they have grossly outperformed the overall market, which is to be expected from this large company, and their past performance and their future outlook, in my personal opinion, are going to continue to grow at this rate. Now we're going to take a look at the actual returns compared to the overall market. So we're going to do these returns with dividends returns included, because of course, as dividend investors, we like to collect those dividends, reinvest them into more shares, and continue to have that compounding effect grow each and every year. You can see here, this goes through all the different timelines, but if we go long term, 5 years, Microsoft's total return is 388%, which is absolutely remarkable. It's beautiful. That is crazy returns to see from one individual company, compared to the overall market, which had a 61, close to 62% total return over the past 5 years. So of course, every single person who watched this video, including myself, would much rather have this close to 400% return in 5 years. But overall, it's very unsafe to throw all your money into one company. So a lot of people tend to not do that. But if you were to, you would see an absolutely huge result. But the overall market of 61% growth, averaging close to like 12% per year over the past 5 years, is nothing too bad overall. It's still nice returns. Now we're going to take a look at current valuation for Microsoft. So there's a bunch of different analysts from a bunch of different websites who all value Microsoft and each stock in a different way. We're going to take a look at a couple different estimates. Don't always focus on one. If you go online and search up current valuations for companies, and one website will say it's overvalued, the next will say it's undervalued, always take them with a little bit of grain of salt. Each company and each website uses different analytics to get to those fundamental analysis. So always make sure you take a couple different perspectives and do your own research before you just follow one simple category or one simple analysis from one company. Take a look here. Current price to earnings ratio is just over 32 at 32.37. Now we're going to take a look at the share price versus fair value. So like I just said, Simply Wall Street has one valuation for fair value. Another company will use a different one. So you can see here, Microsoft is considered 21.7% overvalued at the current share price on Simply Wall Street. Another website might tell you the stock is less overvalued, maybe fair valued, or even undervalued. So take that with a grain of salt, but that's just want to show you that right there. Next, we're going to take a look at forecasted future growth, which is important because no one really knows what's going to happen in the future. These analysts don't know. They're using different analysis methods to try to estimate what's going to happen in the future. Past performance, of course, does not lead to future results, but we really do, as investors, look at the past performance to try to assume and try to hope and try to estimate what's going to happen in the future. So in the next 1 to 3 years, it's estimated that they're going to have close to an 11% growth annually in earnings, which is great to see. Any companies that can grow earnings by 10% each year is very solid. And of course, this is a trend of their past revenue and earnings and their future analyst forecast. So you can see here, this is the current with nice future projections growing year over year in both revenue and earnings, which is always great to see. Next, we're going to take a look at how they are trading their current PE ratio compared to their historical PE ratio. So this is a 5-year chart of their Microsoft's PE ratios. You can see here 5 years ago, PE ratio of 27.46, went up a bit, then it kind of flattened out for over a year around 28, saw a huge spike up to 57, 50, 46. It came back to new normals, and then once again for the past year or so has been trading around 26, 27 PE ratio with the current PE around 32. So there's a couple different ways you can follow and read this out. If you eliminate these outliers, these high 3/4 of 57, 50, and 46, average PE ratio of Microsoft is going to be around 30, 28 to 30. So right now you would think Microsoft's PE ratio of 32 is slightly higher than what it's been over the past 5 years. If you take into consideration these outliers that do skew the average a little bit, the average PE ratio is going to be closer to 35, showing that Microsoft may be a little bit undervalued right now or a little bit cheaper with regard to how much investors are willing to pay per every dollar of Microsoft earnings. So take that with a grain of salt. Always do your own analysis with that, but I want to point out the little differences. If you eliminate these outliers, you can see Microsoft may be considered very expensive right now, but if you include those outliers in your analysis, Microsoft may actually be a little bit cheap. So whatever you believe in, I personally would remove these outliers and just think that Microsoft is maybe a tiny bit over expensive right now, or maybe somewhat fair valued right now. I don't believe Microsoft is super cheap, but of course, with this company, I do believe them in them long term. So even if you were purchased now, or in my opinion, if I were to jump in right now, I always think, do I believe the share price is going to be higher in 10 years? And if the answer is yes, then I really am not too nitpicky about when to enter. If I believe in 10 years from now the share price is going to be worth more, then I believe if I purchase today, it doesn't matter if I purchase today, in a week, or a month, that share price is still going to be higher. And in the long run, those differences, if I were to get in right now at $196 a share, or if just say in a week, for whatever reason, the market goes down, I can get it at $192, I really don't believe that little slight difference over the long term is going to make much to my total returns. So next we're going to take a look at, now we're going to look at a different estimate. So we already took a look at how simply Wall Street is kind of indicating their thoughts about Microsoft. Now this is a different company with different estimates. You can see here, this is the chart of their estimates for earnings per share going forward. And the low, mean, and high estimates all show earnings per share actually growing over the next year, which is great to see. So no matter what with these estimates, even if they are like a little on the low end, it is still actually growing, which is beautiful. Next, we're going to take a look at analyst recommendations. Of course, you cannot always focus on analysts, but we use them just to kind of gauge and kind of build on our own thoughts. That's how I use analyst recommendations. You can see here 36 different analysts went over Microsoft. 14 say it's a strong buy right now, 19 say it's a buy, and 3 say it's a hold. No one is selling Microsoft, no one is strong selling Microsoft right now. The company is the largest company on the S&P. It has probably, in my personal opinion, the most beautiful financial statements that we're going to look at coming up right now. And their financial statements are so strong that I do believe the company is not going anywhere. I still believe they're going to be a force to be reckoned with moving forward. They focus so much on research and development and innovation that I do believe they're going to continue to grow moving forward, and that this company still has strong future outlooks ahead of them. A couple earnings surprises we want to talk about here is this surprise type. You can see each quarter they were in line, so 0.7% in the green surprise, but then over the past 6 quarters, 5-6 quarters, huge surprises. So everything's green. Look at the surprises compared to estimates. Over 10% surprises each and every year, which is great to see, which means the company is actually growing each and every year, and it's actually surpassing estimates and surpassing the averages and the means each quarter. Another little chart that I like looking at here is projections and annual revenue. This one follows the same trend as Simply Wall Street, which talks about how even on the low end, Microsoft's revenue is going to continue to grow over the next few years, forecasted growth at around 12.5% in 2020 and close to 25% in 2021, with a lot of analysts looking at this stock. So those are huge estimates. We'll see in the future if Microsoft actually does reach those, but it'll be great to follow. And if you are an investor, you are going to hope that Microsoft can hit those huge marks, because that's going to be great returns overall in your portfolio. So ticker symbol MSFT, Microsoft. Take a look at those dividends. Of course, as dividend growth investors, that's what I am. I love holding these companies that increase dividends year over year, and I find that essential to be part of your portfolio. So there's 2 types of dividend companies out there. There's those high-yielding 4 to 6% dividend yields with some slower price appreciation and slower dividend growth each year. These companies have higher payout ratios. They may have more sustainable revenues, and they may not have to innovate as much as these tech companies do. Then on the other end of the spectrum, you see those lower-yielding, extremely high-growth dividend companies. Microsoft is one of those. So current yield at just over 1%. Very low, very sustainable payout ratio at around 36%, with insane 5-year dividend growth rate of over 10%, with a 16-year dividend growth history. So Microsoft has such a low payout ratio. They are continuing to innovate and keeping that. They still have 2/3 of their money staying within the company in order to grow moving forward. They pay out just over 1/3 of their earnings as dividends. And because they have so much leftover capital and net income each year, they are growing that dividend rapidly at over 10% over the past 5 years. 16 years consistently been growing that dividend through any recession and depression, and they will continue, in my personal opinion, to grow that dividend very nicely moving forward. Another quick thing I like taking a look at is their dividend safety score. But next, we're going to talk about their company financials, and you will understand exactly why this company has a 99 very safe dividend rating, the highest rating you can receive with very fast dividend growth because of how strong their fundamentals are, how strong their balance sheet and income statement are. This company will be able to sustain that dividend moving forward without any problems. So next, we're going to take a look at the income statement for Microsoft. Always do a look at the financial statements before investing. You want to understand the company's background. You want to make sure they can continue to operate in the short term as well as the long term. And you want to make sure the company's growing, essentially. Share price usually tends to grow as companies grow. As companies become larger, generate more income, more revenue, share price tends to follow. And that's what you want to look at. If you see a company with declining revenues year over year, that may indicate in the future that share price might not be growing at a rate you want it to. It may actually be declining, because if revenues decline, essentially company's not growing and the company may be falling backwards. And those are the companies you want to try to avoid in your portfolios. So Microsoft income statement is, in my opinion, their income statement and balance sheet are one of the best on the entire market. There's not many companies who actually have stronger financials than Microsoft. If you see here, revenue is growing very nicely year over year. 5 years ago, revenue was at $93 billion. Trailing 12 months, revenue is at around $139 billion. Gross profit at around $94.5 billion over the trailing 12 months, which is absolutely astounding. If you take a look at gross profit trend over the past 5 years, you can see every single year, nice raise in gross profit. Overall net income is the next key point we're going to talk about. Similar trend, nice upward trend over the past 5 years. In 5 years, net income has grown 4 times. 5 years ago, net income was $12 billion. Today, it's just over $46 billion. So a 4 times growth in net income over the past 5 years, which is absolutely ridiculous. This company is generating so much cash. It's absolutely beautiful to see. Current net income around $46 billion over the trailing 12 months. Now for earnings per share, another very important metric we're going to take a look at. You can see $1.50 earnings per share in 2015, up to $2.60, up to $3.29. 2018 little decline back to $2.15, but it has fully recovered back up to $5.11. Trailing 12 months of earnings per share at $6.07. Absolutely beautiful to see that upward trend year over year. Next, the balance sheet, in my personal opinion, is the most important financial statement you could see. Everyone has different thoughts about it. Some people like the balance sheet, some people don't, but I do believe it's probably the most important financial statement. It shows you how the company's financial position is at a key point in time. So if you take a look here, the last trailing 12 months for this company have been very well because they've actually thrived from the economic shutdown and the stay-at-home lifestyle. They've actually performed very well, but we don't know what the future is going to hold. We don't know what's going to happen moving forward. We don't know exactly what's going to happen in the next 12 months or the next 5 to 10 years. So we want to make sure this company can weather that storm regardless of what comes. If we see another economic shutdown, and for whatever reason Microsoft cannot perform and thrive as well as they did in the last one, we want to make sure the company has enough assets, enough strong financial position right now in order to weather that storm. So we take a look here at their total current assets. Year over year, you see a nice upward trend in total current assets at around $170 billion, which is absolutely remarkable, compared to their total current liabilities at around $58 billion, which means that their current ratio is close to 3 right now. So they have 3 times as much current assets as they do current liabilities. So in any resort, they have enough assets on hand to pay off all those current liabilities and continue to operate very nicely in the next 12 months. Now we're going to take a look at their total assets. You can see total assets at around $285 billion, absolutely remarkable total assets, compared to their total liabilities at close to $171 billion in total liabilities. So once again, they have a lot of assets on hand in order to pay off all those total liabilities and continue to operate very nicely. So total equity is growing year over year, which is very nice to see. That's kind of the trend you want to see over the long term. Next, the cash flow statement, the final financial statement we're going to take a look at. Very nice financial statement. At the top line's always net income, which we looked at from the income statement, growing year over year. Total cash flow from operations is huge for Microsoft, generating $58 billion in cash flow from operations in the trailing 12 months. Cash flow from operations is cash you bring into the business from day-to-day operations. So what Microsoft actually does in its day-to-day to generate revenue, that cash coming in is cash flow from operations. So their selling of products and their licenses and their services that they operate, that revenue coming in, that cash generated is cash flow from operations. Cash from investing activities. So Microsoft actually spent $15 billion in investing activities, which is exactly what you want to see from this company. This company needs to spend money to research and develop, to acquire other businesses in order to continue to grow revenue into the long term. So they spent $15 billion in capital expenditure. They used some different cash acquisitions, and they invested in different marketable securities. So they invested money in order to generate revenue into the future. Cash flow from finance activities is the third part of this cash flow statement. And this is where it talks about how Microsoft has spent cash with regard to financing. So you can see they paid off some debt. They issued a small amount of common shares. They purchased back a lot of their common stock, and they paid out that nice dividend of 1% per year with huge dividend growth. So they did spend around $42 billion in cash from operations, which of course is nothing too crazy. Nothing here is bad, nothing is alarming. Paying off some debt is nice. They are not issuing a lot of shares. You don't want to have to issue a lot of shares year over year. And you can see they're somewhat flat with issuing shares, which is okay. Purchasing back a lot of their shares. Share buybacks are an interesting topic in the market right now. A lot of news and a lot of thoughts and different perspectives about if companies should be allowed to do share buybacks. And of course, they are paying out that nice dividend with their money, and a little bit of money is going to some other financing activities. Of course, nothing too crazy here. Net change in cash, they have increased their cash position over the last year, which is beautiful to see. With this little uncertainty over the next 12 months, increasing that and bolstering that cash position is a nice move by Microsoft. So I am going to end off this video by jumping back into my portfolio. I am going to thank you for tuning in. So today we did a deep dive on Microsoft stock. We went through the entire company past performance, the future estimates, and overall financial statement review. Thank you for tuning in. I'm the Gen Z investor, and every single day we do come out with videos about investing in different stocks and the overall stock market. So if you're interested in those topics, please hit that like and subscribe button, and I will see you in the next one.